Guys, let's wait for a couple of minutes more so that others can join as well, and then we will start. Good evening, KK. Good evening, GA. Good evening, everyone. So the topic for today's class is cash equities. Good evening, AP. I'm good, dear. How are you? Good evening, SM. So if you guys allow, shall we start? Am I clearly audible, guys? Perfect. So let's start. So in this class, we will be talking about the new module that is cash equities. First of all, what is equity? Equity is nothing but buying a proportionate ownership or percentage ownership in a company. Correct? Can we define equity as being a partial owner or a percentage owner of the company? Yes, right? So when we talk about equities, we could be an equity investor in a public company, or we could be an investor in a private company. In which company would it be easy for us to convert our equity shares into cash? In which sort of investment would it be easy for us to convert our investments or percentage ownership into cash? Basically, what I am asking you is which shares would be easy to sell? Which shares would be easy to liquidate? Public company shares, correct? These shares are easily convertible in cash. So the liquid portion of my investments that can easily be converted into cash is called cash equities. Some of you are saying it would be easy to convert private companies' shares into cash. So I'm sorry, but uh, this is mistaken. Private company shares generally faces illiquidity since they are traded over the counter or between institutional investors, whereas public company shares are traded on exchanges, which makes them easy to trade. And the liquidity, now what is liquidity? Anyone? What is liquidity? Liquidity is nothing but ability of an asset to be converted into cash. Is that all? The ability of an asset that is to be converted into cash at a fair market value is defined as liquidity of the asset. Correct? Talking about equity, we have common equity and preference shares. Talking about equity, we have common equity and preference shares. What are the advantages of preference shares over common equity? We had seen what are preference shares. We had also seen that how are preference shares or the price of the preference shares actually calculated. Let's revise that once again. Uh, no need to raise hands, SS. You can directly comment on the chat box. It's perfectly fine. Public company, yes. So investment in public companies, those investment that can easily be converted into cash, Usman, is called cash equities. Before coming to the advantages of preference shares, let's revise what we had discussed about preference shares. Let's suppose there is a 7% dividend paying preference shares with an annual dividend of 14 rupees. With an annual dividend of 14 rupees, what is the price of the preference shares? What the question is basically asking is, if you want 14 rupees every year as the preference dividend at the rate of 7%, what is the amount that you need to invest today to receive this 14 rupees every year till perpetuity? So the formula is A by I. Did I cover the similar example in fixed income securities? Perfect. So it's 14 divided by 7%, which gives me 200 rupees. Now coming to the theoretical part of it. So guys, this lecture will be morely focused and will have more weightage on the theory part. So I'm sorry, but this is the need of the hour that we have to keep it constrained more towards theory part. So make sure, although I'll try to make it as interesting as possible, but you might considering that what we had covered as a level of content in our past lecture, you might feel that this is somewhat dry content. Okay, so please be attentive. Yeah, anyone who wish to take the photo or pic can take it and allow me to move forward. Shall I go ahead? Perfect. Now, first of all, the question should arise, why preference shares are known as preference shares? Simply the reason being, I think it had been already covered as well, that during the time of liquidation, following is the hierarchy that is usually followed. So what I say, sure, be sure, I'll try that. So let's say that there is a company which has liquidation value of $100 million. What does this mean? It means that the company is shutting down its operations, and all the assets that the company is going to liquidate is worth $100 million. Now, the question is, who will get the claims over these $100 million? Who will get these $100 million? So the first one to get this $100 million would be the debt holders. Once, let's say, debt holders had 30 million claims in these assets, once debt holders are paid, the next person who gets the claim over this $100 million is preference shareholders. Let's say these preference shareholders has 60 million claims. And once the preference shareholders are being paid, the residual will be distributed to equity shareholders, that is common shareholders. So as you can see, guys, the preference shareholders are getting preferences over and above the equity shareholders in the priority of claims. In what? In priority of claims, they are getting preference over and above equity shareholder. That is why the name preference shareholders. I guess this was covered earlier as well. Now, the feature of preference shareholders are, or the feature of preference share is, first, preference share has fixed rate of dividend. Now there is something called as participative preference shares and non-participative preference shares. A participative preference shares, when you take a participative preference shares, you have some right that if company performs better than a particular benchmark, for example, the benchmark is, if the target of the company is to perform net profit or is to generate net profit of $1,000 million, and if the company has generated $1,500 million, then out of this extra $500 million, a small percentage will also belong to preference shareholders. That is called participative preference shareholders. But generally, in most of the cases, usually the dividend rate of preference shareholders are usually fixed. So I remember one of my sir explaining preference shares. Preference shares are nothing but like taking debt from your friend. So when you run a business and take debt from your friend, you can delay the payment a bit, but you cannot uh, just not repay the payments. So what I'm trying to say is, consider preference shares as ordinary debt. Just the difference is the debt that has been taken is from your friend. So you are not obligated it to pay to it at a particular timeline. You can defer it for a bit. That is preference shares. Second, the feature of preference shares is preference share has no voting rights. Usually, preference shares do not have any voting rights. Preference shares serves to be a long-term source of finance for the company. And in preference shares, cost of preference shares for the company is higher than cost of debt. So when we saw that the three elements of the capital structure or the three stakeholders in the capital structure, the debt holders, the preference shareholders and the common shareholders, the amount or the return that the company pays to its debt holders is called cost of debt for the company. The amount that a company pays in preference dividend is called cost of preference shares. And the amount that the company is expected to pay to its common shareholders is required rate of return for the investors, but cost of equity for the company. Okay. Now, considering the risk and return appetite, cost of equity has, since assuming the highest risk, getting the lowest order in the priority of claims, assuming the highest risk, they get the highest return. So cost of equity for the company is highest, followed by cost of preference shares and followed by cost of debt. So based on what we have covered in the last class and earlier classes, you would find that more or less the informations might have been repeated and you might not find anything challenging in this module. And preference shares they don't have the right to select the management. The right through which the owners of the company select the management is lying in the common shareholders' hands, not the preference shareholders. And preference shareholders receive preferential dividends. How is cost of equity highest? Because as a shareholder of the company, as the owner of the company, you are assuming the highest risk. So you assume the highest return. So if a company is giving 8% return to its debt holders, 12% return to its preference shareholders, you would want more than 12% return as a investor in the company if you are investing from the owner's perspective, because you will there is a general mandate that investors are risk averse. Now there are two terms. First is risk averse. Second is risk neutral. The benefit for preference shareholders will be stable source of income. Now, what is the difference between these two terms? Being risk averse or risk neutral. How many of you feel that you are risk averse? You hate risk. You hate taking risk. How many of you feel so? Generally, investors are risk averse. It means that for the same level of reward, investor or a same level of return, investor will go for taking the lowest risk possible, right? So if let's say even the cost of equity is giving you 12% return and cost of preference shares is giving you 12% return, everyone would invest in preference shares, right? No one would invest in equity because here you are getting priority of claims. It is less risky as compared to equity. So why would anyone invest in cost of or or to the equity or the common shareholders equity of the company? So that is why cost of equity is always higher than cost of preference shares. Based on the same logic, cost of preference shares is always higher than the cost of debt. So risk aversion is nothing but a person who hate risk. If you want a person who hate risk to take extra unit of risk, you will have to reward him with extra units of returns. Nevertheless, deleting this. Now, similarly, the features of common equity are please highlight me the features of common equity. What could be the characteristics of the common equity? Common equity represents a part of total share capital, basically partial ownership or proportionate ownership. Same like preference shares, equity also serves to be a long-term source of capital. That is not always the case, GA. There are exceptional dividends like liquidating dividends or special dividends, which are being given to the shareholders of the common equity, even the common equity shareholders, even though the company has not generated any profits. Now, even equity serves to be a long-term source of capital. Can anyone think the problem in this? You should actually, this question popped up in my mind when I read this for the first time, that how come equity be a long-term source of capital for any business? If I am investing in equity today and selling it tomorrow, I have not been the part of business for a longer period of time. So what could be the reason that this says the long-term source of capital, equity or common equity shares, serves to be a long-term source of capital for any business? Everyone understood my point? I have bought shares today, I have sold it tomorrow. So how can this serve to be a long-term source of capital for a business? Company. Okay. So GA is here with the answer. GA says because we are trading it in exchange and no number of shares doesn't get affected issued by the company. Fair enough. So what he's trying to say is a company issues shares through a process called IPO, that is initial public offering. Many investors who wish to apply for this IPO subscribe to this IPO and give their money to the company. On behalf of their money, company gives them their respective ownership percentage, also called as shares. Once these investors have shares, they realize their profit or listing gains through IPO when they sell this IPO or sell these shares received in IPO to the other market participants. So once the IPO is launched in the primary market, it is being traded in the secondary market. So what I mean when I say it is traded, one participant shares gets transferred to other participant shares. One person sell this to the other person. Same happens in the market, and the company's equity that he received as a collection through the IPO payments given by the initial shareholders in the primary market has nothing to do, is not affected by buying and selling of the shares in the secondary market. So the equity that the company has is a long-term source of capital for the company. Okay. SC, please let me know if you have any doubt, Susan, in this part. What I'm trying to say over here is, let's say if you have issued the company, if you are the owner of Zomato and you have came up with the IPO, once the amount of bid received by you has been credited to your account, you have transferred the shares. It depends on you how you want to use that money. You can buy assets from that, you can buy property, plant, or equipment from it. You don't have to actually worry about whether the shares will be sold in the market or not, because the shares are being sold to the other participants. So HP, if you are selling the shares, I am buying it. How does Zomato has to do anything with it? What about companies with zero promoter holding? Those companies are complete red flags. Those companies have no future, and one should very much prohibit themselves from investing in such companies. So the feature of equity share includes ownership rights, voting rights, the right to select the management. Equity is permanent source of capital. Common equity shareholders gets right to receive corporate action benefit. Now, what are corporate actions? Corporate actions can be stock split, share buyback, stock dividend, cash dividend, etc. So these are corporate actions. We will see each of these in detail in next few minutes. But common shareholder equity, common equity shareholders gets the right to receive the benefits arising through these corporate actions. These are transferable in nature. One can buy the shares and sell it to someone else. Yes, even merger and acquisition is a part of corporate action benefit. The next feature is it comes with a higher risk but rewards through capital appreciation, and with voting rights, they have power to elect the management. Now, the advantage of investing in equity is equity equity provides cushion against inflation. Cushion against inflation. So not really it 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 does we cannot define corporate actions as uh, some events that uh, affects the share price of the company, but corporate actions are the actions taken by management to turn around or change the business or change the capital structure of the company. So there are various events that only corporations can take. There are various actions or events that only corporations can make. A sole proprietor or a private business cannot make those things. So that is why these are known as corporate actions. So we will be going to see what are those corporate actions and how that each of those particular actions affects the share price of the company. Now, equity, investing in equity provides the cushion against inflation. What does this mean? When inflation rises, prices go up. When prices go up, net profits of a business might improve. When net profit improves, share price of the business might improve. And when share price improves, you will get or enjoy capital appreciation. So equities are also considered as a potential inflation hedge. Equities are considered as a potential inflation hedge. Public companies' equity are easily liquidated, can easily be sold. While the disadvantages of equity could be higher risk or highest risk in the capital structure, highest risk in the capital structure. Yes, when evaluating from the firm's point of view, cost of equity has the highest cost of capital compared to the three capital structure or the three sources of capital. Equity investor is always exposed to social and political risk. The best example is recently when the election results were announced, you might have seen that all of your portfolios were in red. Yes, that is one case. And then uncertainty of dividends. Basically, no fixed income like preference shareholders or debt holders. And finally, the lowest priority of claims. So at times of liquidation, SGA, equity holders would be the last one to be paid off. Now, what are dividends? Dividends are nothing but distribution of profits. So let's suppose a company has okay, AS wanted to see the page for a minute. Let me know, AS, when you are done. Perfect. Dividends are nothing but distribution of profits. Let's say you are running a business and you have generated $250 million. Let's say you are running a business and you have generated $250 million. What you could do of these $250 million? What you could do from this $250 million? Either you can reinvest it in the business so that this amount compounds itself and give you a better return in future. This would help for the growth of your company, and that growth will be reflected in the share price. The next thing that you can do is take out this dividend, take out this profit out of the company and use this for personal use. So when shareholders or management distribute the profits, when management plans to distribute the profits to shareholders, why? Because shareholders being the ultimate owners of the company, they come up with dividends, they announce dividends. While deciding dividends, there are few dates, few important dates and terminologies that one should know about. So this is called the timeline of dividend payments. So the first one is announcement date. Next one is X record date. Sorry, X dividend date. X record date. X dividend date. Then timeline for dividend payments. Timeline of dividend payments. So how the dividend, from the time when the dividend is announced till the time the dividend is actually credited to your account, this is the timeline that is usually been followed. X dividend date, then record date, and finally the payment date. Let me take an example. 1st July, 10th July, 15th July, 27th July. On announcement date, the dividend is announced. It is been released in press by the management that the following company is going to pay the dividend. Now, who are going to receive this dividend? Anyone who holds the share before 10th July. One, the people who have delivery of these shares before 10th July are going to be entitled to this dividend. So on the books, on the shareholder sheet of the company, of the management, will see who are the shareholders holding shares on or before 10th July, who have the delivery of my shares on or before 10th July. Those people will be entitled to receive the dividend. On record date, the company checks its record. The company checks its records and make a list, make the preparation with the information of the people who are their shareholders, and make the preparation to distribute the dividends to their respective accounts. And on the payment date, on the payment date, the dividends are credited in the account of to the account of investors. Okay. Now, dividends can be cash dividends, and second one is stock dividends. Suppose you purchased on 9th and sold it on 17th. Yes, you can get the dividend. You will get the dividend because on record date and an ex-dividend date, you had the shares, you were holding the shares. But if you purchased on, sorry, Priyanka, if you purchased on 9th, you won't get the dividend. If you purchased on 8th, you get the dividend because some countries, it depends which country are you following or which country you are investing in. Some countries follow T+2 settlement. Some countries follow T+1 settlement. India follows T+1 settlement. So on 10th July, if the shares are being credited to your account or shares are being delivered to your account, then you will be entitled for the dividend. If the shares follow T+2 settlement cycle, then when you buy on 9th, you will receive on 11th and you won't be entitled for the dividend. If you sell on 12, if you sell on 12, probably yes. Even if you sell on 12th, probably yes. But you can't, what you're thinking is not possible because on ex-dividend date, the share price of the company falls. So if you are buying on 9th, let's say you are buying on 100 rupees, and when you try to sell it on 12th, you will have to sell it at 90 rupees if 10 rupees is the dividend paid by the company. You are trying to make a riskless profit. You are trying to make an assured profit from the announcement of dividend, but that is not practically possible to be implemented because at X dividend date, in most of the cases, yes, it does happen. And you don't know in which cases it won't and in which cases it will. So I could not make a general remark and give a strategy to everyone that you can invest one day before X dividend date and sell the shares after one day. So you need to evaluate carefully about it. X dividend date is basically X is right. X is about past. So before this date, if you have shares in your demat account, you will be entitled for the dividend. That is X dividend date, Anshuman. Okay. Now the dividends can be of two types: cash dividend and stock dividends. But as per my info on record date, a person have shares. Correct me if I'm wrong. Okay, let's check. Let's check. Someone please Google that if someone buys or try using chat GPT, someone tries to buy shares one day before X dividend date and sells it before record date, will he entitled to be receiving the dividend? Please someone Google it. If someone buys shares one day before X dividend date and sells shares one day after the X dividend date, will he entitled to receive the dividend? Probably not, because maybe on record date, while checking the records, probably I will have to check, I will have to confirm. Probably not, because on the date of checking the records, the record won't see that person, the company won't see that person in that list of shareholders. Yes, he should be the owner. If he is the owner at X dividend date, if he is the owner of at X dividend date, will he be entitled to receive the dividend? Because on this date, on 15 July, when the company will see the records, the company probably might not find record of that particular person. Or if there might be a scene that they can see the past records. So please confirm. This is really an interesting question that never popped up in my mind. That if a person record date is important, okay. So you need to hold the shares. You need to hold the shares before X dividend date and at least up to the record date to receive the dividends, right? Am I correct in making this remark? Okay, so we need to hold the shares. We need to hold the shares right before X dividend date up till the record date to be entitled to receive those dividends. Perfect. Now dividends are of two types, stock dividends and cash dividends. How are cash dividends different from stock dividends? In a cash dividend, the shareholders get a particular amount in currency denomination, maybe in rupees, maybe in dollars, credited to the cash get credited to their bank accounts. The amount that is distributed on a per share basis is called dividend per share. Stock dividends, also called bonus shares. Stock dividends are also termed as bonus shares, are entitled to existing shareholders of the company, where the company gives extra shares, where the company gives extra shares, company issue new shares and distribute those shares, extra shares, to the existing owner of the company, to the existing owners of the company. Similar to issuing new shares, company can also announce a share buyback. Not able to see the screen, guys? Are you not able to see the screen? Perfect. MS Manisha, probably the issue is from your end because everyone else in the class is able to see the screen. Yes, they are, that are in the proportion obviously in their current shareholding. So if dividend per share is 10 rupees, someone holding 10 shares will get 100 rupees, someone holding 100 shares will get 1000 rupees. Bonus shares are announced in ratios. So if the stock or the company has announced 5:1 bonus, it means that for every 5 shares, the company will give 1 bonus shares. So you will see after once the bonus shares get credited to your demat account and you already had 5 shares, the new shares available to you for sale will be 6. That is stock dividends. Apart from stock dividends, there is something called a share buyback. Now, let's suppose the existing share price of Vodafone Idea or Netflix, why company issues bonus share? To attract investors to invest in their company. So why a company gives bonus to their employees? So that employee be passionate about working for that company. Similarly, a equity investor investing in the company will be there in the company for generating profits, right? And this bonus shares terms or serves to be a source of profit. That is why company issue bonus shares. Where do all the bonus shares come from? They issue new shares. So what company can do is company can issue new shares, company can repurchase their shares, that is called share buyback. Share split and bonus shares, that I will tell. Although there is one single difference, one significant difference that differs a stock split from bonus share, but since I have not discussed stock split yet, uh, it is not the appropriate time for me to make the comparison, right, KV? So let me just come to stock split and I will definitely be explaining what is the difference between stock split and bonus shares. If you know, the basic difference is here the company is issuing extra shares. Over there, the company was just splitting their existing shares into two parts. That is the only difference. Okay, share buyback. Let's say Netflix is trading at $400 and the company has announced a share buyback. It means that investors who had Netflix shares purchased Netflix shares for $400, or the current market price of shares is $400, can sell it back to the company, sell it back to the company at $600. Recently, TCS came with a share buyback where the companies at that time the market price was around 3,150 and they announced a buyback at 4,200, around 4,200, I suppose, which is beneficial to the company, cash dividend or stock dividend. It depends to the company's capital structure and also how positive and how quick is the company to react to positive, to grab the opportunities for positive NPV projects. So if there is a company SC, you are running an aviation company. Aviation company demands huge capex, and in the early stage, you will have a huge cash requirements. In that case, cash dividend won't be a preferable method for you. Instead, you should go for a stock dividend. On the other hand, if the company has many surplus cash and is not able to efficiently allocate that cash, it's advisable to distribute those cash to where it belongs. That is the shareholder of the company through cash dividends. In that case, cash dividends would be an appropriate method for you. So it differs from company to company, industry to industry. Okay. Does that means reducing the issued share capital of the company? Not really, but the number of shares falls when the companies buy back the share. When company issues new share, number of shares rise, and when company buy back the shares, the number of share falls. Overall, the impact on issued share capital does not change. What if equity holders know the value of shares and do not wish to sell it in case of buyback? Then how company deals with this? If they are not able to sell it, it's perfectly fine, because not only promoters. So basically, there is something called as treasury stock method. That is something which is a kind of an advanced topic to be discussed over here. And then there is something called as weighted average number of equity shares, WANES. So treasury stocks are those, through treasury stock method, what a company basically do is I'll tell you, GA. Just give me a second. Let me just complete stock split and I will explain what is happening over here. What if equity holders know the value of the shares and do not wish to sell it? In case of buyback, then how company deals with this? So the company has announced to buy back 50,000 shares, and there are 5 lakh existing shares in the market. If you as an investor do not apply for that buyback, you won't be selling your shares in the buyback process. So it's completely fine that if you don't want to participate in the buyback process, you can keep your shares with you. The company won't force you to give their shares back to them. Now, this is GA. What you talked about is mostly a chicken and egg situation. I will explain you how. Let's suppose I announced this 50,000 new shares will be issued in year 2020. And in year 2022, the company announced a buyback of 25,000 shares. The company announced the buyback. No, that is not the case. So Nikamni is asking if investor don't want to get the buyback, will they get the cash dividend? No, that is not the case. The investor won't get the cash dividend. If he is not participating in the buyback, he is letting this opportunity go. That is the case. Okay. So GA, if 25,000 out of 50,000 is bought back by you, the number of shares in available in the market is 25,000, right? Now the question is the 25,000 that the 25,000 shares that the company bought back, who will receive dividends? If dividends in announced in, let's say, 2023, who will receive these dividends in these 25,000 shares? Will the company distribute these dividends in these 50,000 shares, or will the company distribute this dividend only to these 25,000 shares? Think about it. And not only GA, everyone think about it. What GA asked is basically that when company issues buybacks, company repurchases their shares, what happens? Does the equity share capital reduces? Because if you see, if company pays dividend to this 25,000 shares, and these 25,000 shares is having, the company is having these 25,000 shares, will the company pay dividend to itself? Will the company pay dividend to itself? So basically, in this 25,000 shares, the company is the on these 25,000 shares, the company does not pay any dividend. Company just pay dividend in the residual shares that is available in the market. Basically, you can say when the shares are repurchased, company absorbs these shares. The company absorbs these shares. The value of these 50,000 shares is now absorbed by only these 25,000 shares. So the share price in the coming time will increase. Okay, GA. Shall we go ahead? Then the another corporate action strategy is stock split. Basically, let's say you had one share of Vodafone Idea at you had one share of Vodafone Idea at 20 rupees. and company has announced a stock split. When the company has announced stock split, this one share will be splitted in two equal parts of 10 rupees each. So let's say company has announced 1:2 stock split. It means that your one share will be converted into two share of 10 rupees each. Okay, $10 each. $10 each. Let's say you have shares of Netflix and Netflix shares are traded at $400. When Netflix announces 1:2 stock split, the each share will be worth $200 after the implementation of the split. Now, why would a company announce stock split and how it is different from bonus shares? In this, under this stock split, basically what happens? Company does not issue new shares. Company does not issue new shares. Why companies split their own shares? I'll tell you why. Company does not issue new shares. Instead, they split their existing shares into various proportion. What is the impact? Let's say the face value of the share was 10 rupees and company has announced a stock split of, let's say the face value of the share was 10 rupees and the company has announced the stock split of 1:10. It means that this 10 rupees of face value will now be divided in 10 equal parts and the new face value will be 1 rupees. The question is, why would a company do that? Correct. One question is, sorry, one answer to this is to improve liquidity of their shares. Let's say there were existing 10,000 shares in the market. There were 10,000 shares of the company in the market and there is no fractional ownership. It means that like in Bitcoin and cryptocurrencies, you can own a partial share, 0.5 share, 0.25 share, 0.2 share. Yes, the volume has increased, but the value has remained same. Correct, BS. So where was I? Yeah. Out of these 10,000 shares, there is no fractional ownership available. It means that at least you have to buy one share. So what would be the maximum number of shareholders of the company? What would be the maximum number of people investing in the company? 10,000 people. Considering the worst case scenario where every single person holds one share per person. But if the same company wants to make a huge crowd, a comparatively broader market or target the broader market and make people connect to them, they have announced a stock split of 1:10. It means that these 10,000 shares will be converted into 1 lakh shares. Now, how many people will be able to participate with this company? How many people will get the exposure to this company? 1 lakh people can get exposure to this company. So this is how companies use stock split as a corporate action strategy to improve liquidity. Apart from that, it also makes shares affordable. Let's say that Berkshire Hathaway has been trading at $0.5 million. $0.5 million and there is no fractional reserve system. Dividend is a different strategy and stock split is a different strategy. So yeah, if the company has announced $1 dividend over here, The company had to distribute in 10,000 shares, but now they will have to distribute it in 1 lakh shares. Okay. But what company can do if they have distributed $1 over here and they want to distribute same amount of dividend, they could distribute $0.1 over here and the impact of the dividend payment would be same. Nevertheless, let's keep it aside for a while. Berkshire Hathaway is trading at $0.5 million. And if you want to invest or get one share of Berkshire Hathaway, since fractional, considering an exemption that although in US it is possible to own fractional shares, but considering if fractional ownership won't be possible, how could an investor, a retail investor, would have invested in Berkshire Hathaway? So to deal with this issue, Berkshire Hathaway has distributed these shares into 1:1 million. Each share will be available for $5. And this would in turn be available to retail investors. For our Indian student, MRF is the better example. Yes, it is trading around 1 lakh. So minimum amount that you need to invest in MRF is 1 lakh. But if MRF comes with a 1:100 stock split, each share will be available for 1,000 and more participants would be able to react to the latest news of the MRF, improving the market efficiency, and more, this MRF shares would be affordable to many people. Okay. Next, guys, do you want a break? Shall we take a 5 minutes break? Let me take a sip of water. You guys also freshen yourself up and then we will start. But please be back on time. We have to start with rights issue. Yes, KB, I'll try that. So those who had raised the ticket, guys, have you received any mail with the PDFs? Have you received any mail regarding the notes and the PDFs? I told them, I highlighted the issue to the team, to the technical team, and I advised them that what they can do, they can um, do a email blast. Yes. How to check companies doing share split and bonus shares. We will see that when the company announces share split or bonus share, the issues in the market. So various brokerage houses or various newspaper that the company covers comes up with a news article that the following company has announced 1:10 stock split, 1:10 bonus shares or such. So guys, please check your inbox. I can see many people have received the mail. Please check your spam folder as well or the inbox. You might get all the PDFs in that case in your inbox or the spam folder. Please check on your registered email address. Please check, guys. I have received few confirmations that they have received the PDF on their mail. The team might have uh, shared the PDF by name. Guys, what is the subject line for the mail? What is the subject line for the mail? Please let me know. Yes, yes, I am talking about the bookish notes. The subject line for the mail are notes, only notes. Okay. Yes, it is also available on the exchange website if the company is announcing or coming up with any corporate action strategy. If guys, if you have not received those PDF, raise the ticket. The PDF will be mailed to you. Okay, guys. So let's take a 5 minutes break, but be right back on time. Yes, we will be completing introduction to IB tomorrow. The last session, I guess it was about cost of capital. Guys, shall we start? Shall we start if you guys allow me? Okay, received one response, two, three, four. Okay, let's wait for a couple of minutes more. I think not everyone has joined. Okay. Let's wait 1 minute more and then we will start. Okay, let's start. Let's start. Under a right issue, the company gives what this email ones I'm referring to? Are these referring notes to what you share at the end of the class? The email ones I'm referring to. I'm not getting RK what you're saying. Sir, are these different notes to what you share at the end of the class? The emails one. Yes, those are different. Those are printed notes, PDF notes, uh, and also with along with the notes that we scribble during the class is also being sent to you through the PDFs. Okay. Through the right issue, the company gives the right to their existing shareholder, to their existing shareholder to buy new shares at discounted price. To buy new shares at discounted price. So there was a company called Ajuni Biotech, which recently came up with the right issue. The reason why I gave this an example because I read the news about this company. Although many companies comes with a right issue, so when company comes up with a right issue, company basically gives the right to their existing shareholders to buy the same company share at a discounted price. For example, if shares are traded at 100 rupees, company will allow these shares and give these shares to their existing shareholders who have been the part of the company and contributed to the growth of the company. The company will offer these shares at a discounted price, let's say 60 rupees. So that is called right issue. Now, coming to share capital, also one important thing before concluding on right issue is also in the ratios. So it could be 1:1, it could be 1:2, it could be 1:3. Now, what does this mean? So let's suppose if it is 1:1 right issue. So when the company announces right issue, you get something called as right entitlement. These are nothing but basically rights to buy the shares. So what you can do is when the rights entitlement before the application window or during the process when the application window is open for the right issue, you get something called as RE shares, right entitlement shares. So if you want to apply for the right issue, you can apply for the right issue, or otherwise you can sell these right entitlements to someone else. Let's suppose I am not the existing shareholder of the company. So what I can do is I can buy this right entitlement from you at, let's say, 1 rupee per share, and the current market price is 7 rupees, and the price determined for right issue is 5 rupees. So effectively, I am paying 1 rupees to you, 5 rupees to the company, and getting those shares at 6 rupees. Once I have got those shares at 6 rupees, I can sell it for 7 rupees if the market has sustained the price level of, if the company has sustained the price level of 7 rupees. So I can share or trade right entitlements as well. I can trade right entitlements. Now, in case of 1:1 rights issue, if I have one share, I will get a right to buy one another one share at 5 rupees only. If I have one share, I will get a right to buy two shares at 5 rupees. If I have one share, I will get to buy three shares at a discounted price of 5 rupees if the prevailing price in the market is 7 rupees. So this is about right issues. Now talking about the share capitals, basically the contribution made by owners are called share capitals. There are various terminologies associated to this as well. The first one is authorized capital. Basically, KS, in a right issue, what happens? The companies allow you to buy those shares at a discounted price. The rights that is been credited to your demat account is termed as right entitlements. What you can do is you can buy these right entitlements or you can sell these right entitlements. Let's suppose KS, as an existing shareholders, you were offered these right entitlements, but you don't need to apply. You are not interested in applying to the right issue that is been released by the company. So what you can do, you can sell these rights to me. I can buy these rights from you at a price called as the price of the right entitlement, RE price. And using those right issue, I can apply for the shares. I can apply for the shares and the shares will get credited in my demat account. I can get those shares at the discounted price. Renouncing of right shares, correct. Doesn't warrants also work the same way as right issue? Warrants are nothing but embedded options. So warrants are more or less related to bonds. In a bonds, you get an attachment where you can convert those bonds to a shares in future. Those are warrants. So warrants are not usually used in case of shares. So in warrants, what happens? A predetermined price is given, and at that price, you have a right to convert it at a future date. Warrants are usually attached with bonds. Just a second, guys. It's it's in June, and in most of the Indian cities, the rains have not been started yet on the full swing. I don't know what will happen this year. Mm, Majority there are stock warrants only, but right issues are given to shareholders. Warrants are issued. I'm not sure about it. Warrants might be privately placed, but are the warrants issued? I'm not really sure about it because I have heard news about right issue being released. Right company has came up with right issue, but warrants has company came up with warrants. Warrants are mainly might be used in private in terms of private company deals or deals related to private equity. In case of public equity and cash equities, a right issue is majorly followed. Please correct me if I am wrong, GA. What is the need of right issue if company can get a better value from the market? Why to give it for less? Because at the end of the day, when the management of the company, the objective of the management of the company is to maximize its shareholders' wealth. So if company will give or follow this corporate action strategy like right issue, bonus shares, uh, cash dividends, more and more people will be interested to invest in those companies. And the company will attract quality shareholders. That is why. So PP is there with a very genuine question that if the company can issue shares at a better value, why they are giving right issues? So that they can give the benefit to the loyal shareholders that has been stick with the company from their past. Okay. Share capital. One is authorized share capital. Now, what is authorized share capital? Let's suppose there are 5 promoters, A, B, C, D, and E. All these 5 promoters will come together and decide that we need this amount of money. Yes, it is mentioned in Memorandum of Association, correct? Memorandum of Association is the document where the promoters come together and highlight the objective needs and resources to run a business. So all these 5 promoters will come together and decide to run our business, to expand our business. We need this much of capital. So this much of capital is what we can issue. Let's suppose that capital is $5 million. Out of that, all these $5 million won't be issued in one single time. Out of that, the part of capital that is being issued today at this point of time is called issued capital. Let's suppose promoters and the founders have different series of funding, series A, series B, series C, and then they come up with the IPO. So what they can do is issue $1 million today and keep $4 million to be issued later. In the series, in the second round, they can issue additional $2 million, and then they will be left with issuing $2 million in the third round. Because at one single point of time, it might not be practical for the company to raise this much amount of money, altogether $5 million. So they can issue those shares in part. So that is issued capital, the percentage of total capital that is being issued by the company, the percentage of authorized capital issued by the company. Now, there might be a case that the company wants $1 million, but the investor bids that they have received is only worth $0.4 million. It means that the company IPO is subscribed 40%. It means that they wanted although $1 million, but the people have invested only $0.4 million in that company. That investment is called subscribed capital. Maximum value of capital a company can issue by the consideration of the promoters and the board of directors is authorized capital. Correct. This is called subscribed capital. It means that authorized capital, the promoters have given the authority to raise this much amount of money. That is authorized capital. Now, called up capital, let's suppose $0.4 million company received out of the subscribed $0.4 million is the subscribed capital that the company received. Out of that, let's say $0.3 million company used for their expansion, for taking inventory, making payments to their suppliers, and so on. So that is called up capital. And then paid up capital. This is through point of view of investors. Total how much money investors have paid up in the company. Total how much money investors has given to the company. Now, when these capital are issued for the first time in the market, in the capital market, yes. If anyone wants to take the photo, they can take the photo. Let me know, Usman, if you are done with this. Okay. Paid up capital is equals to called up capital minus arrears value. So let's suppose that I'm explaining subscribed capital and called up capital again. Let's suppose a company came up with the IPO of 1500 million. Let's suppose the company came up with the IPO of 1500 million. It means that company wanted 1500 million of funds through this IPO, but out of the applications that they received, they only received 1000 million of funds. So 1500 was the issued capital, but out of which only 1000 million was subscribed. So this is subscribed capital. Got this? This is subscribed capital. Next is out of this 1000 million, company took out 800 million, used it for their own use. So yeah, a part of these total capital, company is successful in raising. Out of this 1000 million, 800 million is called up by the company, it means that company will use this 800 million for their expansion purpose, for making payments to their suppliers and so on. And the rest 200 million company will keep it in reserves. So called up capital is the portion of subscribed capital that is being used by the company for payments. Okay. Now the capital that the company needs, how will the company get those capital? The company issue new securities. Welcome, Usman. So company issue new securities to meet these capital requirements. The company issues new securities to meet these capital requirements. These securities, where the place where these securities are issued for the first time is called primary market. So if I define it in one word, primary market is a place where the securities are issued. On the other hand, secondary market is the place where the securities are traded. So IPO, initial public offering, happens to be in primary market. Once the IPO is listed, it will be traded among the investors in the secondary market. So if the company wants to issue new securities, they will come to primary market. They are here, the issuer directly takes bid from the investor, and it facilitates, the role of the primary market is that it facilitates capital formation in the economy. Okay. Now, how does IPO process actually works? On the first place, a book running lead manager is appointed. What is book running lead manager? Now, this is going to be very interesting, guys. If you guys please focus on this. Book running lead manager, basically an investment banker or an investment bank who has been appointed to initiate the process of IPO. So the investment banker has to decide the price band of the IPO, the valuation of the IPO, the lot size, right? What is IPO? IPO is initial public offering. Initial public offering. Company is coming out with its shares to the public for the first time. That is initial public offering. Okay. Now, these deals between the investment bankers, and let's say founders or the promoters of the company can happen under the two ways. One is underwriting issue. Yes. One is underwriting to And the second is on best effort basis. Now let's suppose that GA is a founder of GA. Tell me the name of your company that you want to be the founder of. Let's say GA Group. GA wants to be the founder of GA Group, and GA is the founder of GA Group, and GA wants to come up with the IPO. So how will he deal with DK, an investment banker? To gauge the right price or right valuation of GA Group, this investment banker, that is DK, will reach out to various institutional investors and high net worth individual. High net worth individual and ultra high net worth individual. This investment banker or merchant banker will try to find the interest of these institutional investors and high net worth individual for investing in GA Group. How many of you, please tell honestly, how many of you are watching match and not listening to the lecture? I think all of you, because no one is replying. Okay, fine. Perfect, perfect. At least received 4 responses, 5 responses. Perfect. Fair enough. 6, 7. Okay, fine. You guys are here. You guys are here. I got it. Thank you. Even I am excited about the match, guys, but let's wait for 15 minutes. Let's get done with this. Institutional investors, high net worth individuals, and ultra high net worth individuals. The investment banker will reach out to them. Don't tell me DR all this. DR is saying that we are 3 wickets down. So please let me just finish this. Otherwise, it would be very much difficult for me to resist the nevertheless. Okay. So the investment banker will go to institutional investors, high net worth individuals, and ultra high net worth individuals, and try to gauge their interest for investing in GA Group. Based on the interest and bids that he has collected, he will try to find that whether GA Group is a hot cake in the market or GA Group is going to be a flop show. The reviews of these investors are very high. If most of these investors wants to invest in GA Group, the investment banker will go for an underwriting issue where the investment banker, what he gives is the guarantee that, remember, there was something called as issued capital. Let's say GA Group wants 1500 million of issued capital. Now, if the issue is underwriting issue, the book running lead manager, that is basically an investment bank, has to take the guarantee that this 1500 million of the issue will be subscribed. In case of any shortfall, how does IB investment banks get gray market price? IB don't get gray market price. So they try to gauge the gray market is basically an unlisted market. So they try to, and not everyone in India invests in an unlisted market. High net worth individual, institutional investors, and active players of private equity segments invest in unlisted market. And based on the intentions and the demand of these investors, gray market premium is actually been decided. Uh, Nevertheless, so in case of any shortfall, then 1500 million, this book running lead manager has to make sure that he overcomes that shortfall. He overcomes the shortfall. So let's suppose if GA wants 1500 million, and out of which the subscribed capital through the IPO is only 1000 million. So the rest of the shares, rest of 500 million worth of shares should be bought by the investment bank to overcome the shortfall. And how will investment bank arrange for the funds from the high for this 500 million? They will go to these institutional investors, these high net worth individuals and ultra high net worth individuals who showed interest for investing in this firm, that is GA Group. If he finds that no one is interested in investing in GA Group, and he predicts that GA Group is going to be a flop show, what the investment banker does is go for an issue with a best effort basis, where the investment banker clearly mentions to the promoters and management of the GA Group that I can't give you guarantee, I can't guarantee that the issue will be subscribed, the issue will be 100% subscribed, but but I will I will try best of my efforts to get it subscribed. So this is the difference between best effort basis issue on the best effort basis and an underwriting issue. Now, merchant banks, yes, that is stated as underwriter, one who underwrites the issue. Merchant banks, yes, that is a performance fee associated to the issue that IBs get. There is performance fee based on the interest that they are able to gauge from the market and the number of people applying to the issue. That is usually around 3% to 7% of the total issue. Sometimes it may be more, sometimes it may be less. Smaller the firm, higher the commission that IB charge. Now, sometimes what happens that for an individual investment bank, it won't be possible to collect a huge amount of money. Let's suppose Maruti Suzuki is going to come up with an IPO worth 25,000 crores. So Maruti Suzuki is an Indian company. Consider this, that Maruti Suzuki is coming up with an IPO of 2.5 billion. So to in rupees terms, right? Rupees terms. So for one such investment bank, it won't be possible. For one single investment bank, it won't be possible to arrange for such a huge amount of funds. So what investment banks do, they what the company will do, they will appoint a lead banker, a lead investment banker, and this lead investment banker cooperating with in cooperating with the company's management will appoint syndicate members. What are syndicate members? Syndicate members are basically the banks that will assist the lead banker in arranging the funds or coming up with the issue. Then, then there is registrars. Earlier, earlier, like 20, 25, 30 days earlier, there were no online applications, right? So what these registrars used to do, they used to set up collection centers. Now, what these registrars do, these registrars, if you might have applied for the IPO, there is KFinTech and other registrars in India. They shows the result of the IPO, whether you have been allotted or not. Once the allotment has made, the credit of shares to be made in your demat account is the responsibility of registrars. And if the allotment is not made, the refund to be initiated is also what registrars takes care of. Then there is something called as draft red herring prospectus. It mentions the need of the fund, why company is going to, why the company is coming up with the IPO, what will they do with all those funds, whether it is an offer for sale or whether it is a fresh issue. If it is an offer for sale, it means that the company's promoters are selling their stakes and offloading their stakes. Yes, Usman, I am coming to that point. Just let me complete this. And please listen that what I'm saying over here. I'll come repeat that point again for you. Don't worry. If the IPO is offered for sale, it means that promoters are it means that promoters are offloading their shares. On the other hand, if the IPO is a fresh issue, company is issuing new shares. Often through public perception, offer for sale is considered to be a red flag for the company and fresh issue is considered to be a good or a green flag. Why offer for sale is considered to be a red flag for the company is because when promoters are selling their stakes in the business, it gives the idea to public that promoters are not confident about their business. Now, syndicate members are those members which helps the lead banker in arranging the funds for the IPO, in running the branding and marketing campaigns. So you might have seen that while a company comes up with the IPO or FPO, various news article publishes that following company is going to come up with an FPO or an IPO. FPO is basically follow on public offer. Consider FPO as an IPO by a already listed company. Okay. So syndicate members helps lead investment bank in arranging for the IPO if the issued capital is very much high and it cannot be arranged by one single investment bank alone. Then there are registrars who assist in the IPO process by setting up collection centers. They organize now websites for the online applications. Then there is allotment which is made or not is being displayed in their websites. If the IPO is allotted to you, they will make sure the IPO gets credited to you before the listing date. And if the IPO is not allotted to you, they will have to make sure the refund is initiated. This is what registrar does. Now, investment bankers also have to run marketing campaigns so that more and more people are aware about the IPO. One such successful campaign that I could think of recent IPO was Tata Technologies. The marketing buzz, probably due to the brand name of Tata or due to the marketing campaign initiated by the investment bankers, Tata Technology attracted a very good response from the subscribers. Once the allotments are finalized, if shares is been allotted to you, it will be credited in your demat account. If it is not, the refunds will be initiated. Now, the question is, how does the company decides that, let's suppose if I need 1500 million of funds, what percentage should I dilute? Or what percentage of the company, how many new shares should be issued? No, that is not based on the book value of equity. It is actually based on the market value of equity. That is the prospect G I am coming to. That is what I am discussing now. What percentage should I dilute, or how many shares should I actually, how many more shares should I issue? Basically, if I am selling 15% of the company, at what price I should sell this 15%? If I am selling 25% of the company, at what price should I sell this 25% of the company? This, the process to come up to the right value for the share is called valuation. And this is what we are going to start from the next week onwards. And that is going to be a very exciting module. Now, there are various approaches to valuation. The price band at which it will come, at what valuation it will come, has the investment banker left any scope for listing gains or not, is determined by the approach followed for valuation. This approach can be used. The valuation can be finalized using a DCF model, that is a discounted cash flow model, or a relative value approach based on price multiple. Okay. Then there is a fixed price issue and a book building issue. As the name suggests, fixed price issue has fixed price. Book building issue is issued between a range. So if fixed price issue, let's say, is priced at 500 rupees, book building issue might be priced between 490 to 510. You can place your bids based on this issue, but make sure while applying for the IPO, if you select the cutoff price, that is the highest price of the bid, the chances of allotment are higher. And if the IPO is oversubscribed and has attracted a huge subscriber interest, if you have not ticked this cutoff price, if you have applied at 490 rupees, there is a 100% chance you won't get allotted. In a fixed price issue, what is the demand for the IPO? What is the subscriber interest in the IPO is only is only made available once the IPO is closed. On the other hand, in a book building issue that happens in most of the cases in the IPO, after every day for the period of which the issue is open, the results are being announced, the reports are being announced that today the IPO was subscribed 10 times, 20 times, 30 times, or so on. At the day of end one, Tata Tech IPO saw 19 times subscription. So this could be a possible news article. Every day the news is published here. Every day the subscription interest is not known. Here advance payment is collected and then refund is initiated. Whereas here there is a process called ASBA, application supported through blocked amount, where the amount is not debited from your account until and unless you are not allotted with the shares. But once you have applied for the IPO, that amount is freezed. That amount is freezed. You cannot take out that amount, because if you are allowed to take out that amount once you are allotted the shares, you could take out the amount from the IPO or from your bank account, and you will be having the shares and company won't get the payment. So the amount is freezed. If you are not allotted, if in case you are not allotted, this amount will be unfreezed. The reservations in application supported by blocked amount. Application supported by blocked amount. In case of reservations, 50% is reserved for small investors. Actually, this is a general remark. The reservation depends and differs from IPO to IPO. Some IPO might have 35% reservation for retail investors and higher reservation for QIP, qualified institutional buyers, QIB. And some of them might have higher reservation of retail clients and lower reservation of qualified institutional buyers. Concluding my final point on secondary market, this module was a bit quick because these are very basics and compared to what we have studied in the past classes. This was just some already built base for you. So that is why it was quick. On secondary market, I would just say the secondary market is the place where the shares are traded between. Okay. take a pic if you want to, although I'll share this. But please be quick, Usman. I have to conclude the session in next 2 minutes. Reservation means, let's suppose 100 million is the issue size, out of which 50 million is reserved for institutional buyers. So mutual fund houses, insurance funds, pension funds will get the allotment for this 50 million, and the retail investors will get the allotment for the next 50 million. This is what reservation is. Reservation means 50 million has been reserved for these investors. Concluding my final remarks on this, secondary market, once after the primary market shares has been allotted to the investors, investors trade those shares to the other market participants, sell those shares to the other market participants. Those market participants sell those shares to others. So secondary market is a place where the trading of shares happens, not issuance of shares, but trading of shares happens through exchanges. And there are different exchanges around the world. Each country has their respective stock exchange, like Nifty in India, Nasdaq in US. Actually, Nifty is the benchmark index. Exchange is NSE. Sensex is the benchmark index. The exchange is BSC. Nasdaq is an exchange. So with this, there is one last point to be made around market capitalization that we will see tomorrow. And with this, we are done with, almost done with cost of capital. Tomorrow we will be, sorry, not cost of capital, but cash equities. Tomorrow we will be starting with, introduction to IB. Thank you very much for listening so patiently. I know it was a bit off peak from our regular lectures, but I hope you enjoyed it as well. Thank you for being there. Thanks a lot for listening to the lecture and being interactive in the class. Thank you so much. I hope you enjoyed the lecture. See you again tomorrow. No worries if you won't be able to attend the class tomorrow. Just make sure intro to IB was covered. Guys, is intro to IB? No problem, Anshuman. Just go through the recordings. Okay, for 0223, introduction to IB is covered. Okay, perfect. Okay, for 0423, it is not covered. Let me check AS, and I will see what happens. If it would have been covered for 0224, then probably you might have holiday tomorrow. So you could enjoy. So introduction to IB is what we will cover tomorrow. For those who it might have already been covered by Shilpi ma'am, don't worry. If it might have already been covered, you would have a holiday tomorrow. Bye-bye, guys. Thank you. Have fun. See you soon.